If you're a beginner, investing in mutual funds can be a great way for investors to create a diversified portfolio without incurring a lot of the extra cost and time. You can say that mutual funds allow investors to invest in different asset classes with just one investment. Long-term investors usually target mutual funds, especially those working to build their retirement accounts. So, if you're also planning on making a long-term investment, mutual funds should probably be considered. Mutual funds work by pooling money from a large number of investors, thousands or even millions of investors. The mutual fund collects investment dollars from the investors and then invests it into different types of securities. Usually, it's a combination of stocks and bonds. And some mutual funds will even use leverage and options as part of their strategy. Whatever the fund does, the manager selects the holdings as per their investment objective, just like a hedge fund might. And speaking of hedge funds, I wanted to let you know that this video is brought to you by ValueWalk Premium. ValueWalk Premium demystifies the opaque world of hedge funds so that you can learn what the top investors are doing and maybe replicate it on your own for your own portfolio. If you'd like to check it out, I've left a promo code in the description. It'll get you 20% off, a no-risk 7-day free trial, and if that's not enough, a 30-day, no questions asked, money-back guarantee. Alright, so without further ado, now that you've got an idea of how mutual funds work and why they might be something that you'd want to invest in, well, let's discuss on how to invest in mutual funds. Alright, so there's no rocket science when it comes to investing in mutual funds. In fact, it's still pretty easy. But if you're a beginner, you'll want to know the basics to get you started. Before anything, it's important to be clear on your financial goals before investing in any mutual funds. Your financial goals are crucial in selecting the type of mutual funds you should invest in. For instance, if you have a long-term goal, such as retirement or your child's college education, then a stock or index mutual fund is probably a good fit. This is because you'll have lots of time to ride the ups and downs of the stock market. The markets always go up in the long run. In fact, if we go all the way back to the beginning in 1913, the S&P 500 has returned on average just under 10%. Now, am I saying that you need to keep your money invested for over 100 years? No, but in general, 7 years is the minimum you want to be looking at for investing in stocks. On the other hand, if you have a shorter term goal, such as buying a home or a car within the next few years, then a bond mutual fund could probably be a better option. For instance, many bond funds offer some form of principal protection, but the returns are relatively smaller than those you'd find in a stock fund. Similarly, if you're saving for midterm goals, for example 5 to 7 years, well, for that you might want to go with a balanced mutual fund which invests in both bonds and stocks. Most mutual funds have a minimum investment requirement that ranges from about $500 to $3,000. Some mutual funds are in the $100 range, and some have a $0 minimum investment requirement. When you're just starting out investing in mutual funds, it's important to know what mutual funds are, including the cost of owning them, their pros and cons, how they work, and so on. Mutual funds typically charge a fee towards management expenses, and this is important. It's so important to be clear on these fees because they impact your actual return. Investors should also have an understanding of the different mutual fund structures. For instance, open-end funds have no limit to the number of investors or shares, while closed-end funds have a limited number of shares available to investors. Now, with an investment goal, budget, understanding of mutual funds, now you're ready to research the potential mutual funds that you could invest in. The best way to research potential mutual funds is to study their past performance and compare their performance with the benchmark. Now, you might be wondering, what is the benchmark? The benchmark is a way of comparing mutual funds' performance against something else. For instance, if a mutual fund invests in technology stocks, well, the NASDAQ might be a good comparative benchmark. Also, like I mentioned earlier, you need to consider the expense ratios of the mutual funds before selecting one. This is because a high expense ratio can drastically reduce your actual return. You should also take into account load fees as well as the credibility of the fund manager when researching potential mutual funds. Alright, so let's look at one of the best S&P 500 index mutual funds out there from Vanguard. This is the Vanguard 500 Index Fund, Admiral Shares Mutual Fund. And it was the first index fund that was available for individual investors and is still a low-cost way to gain diversified exposure to the US equity market. Its expense ratio is very low at just 0.04%, or only $4 for every $10,000 invested per year. But you have to have a $3,000 to invest to get in. And with this mutual fund, the benchmark is the S&P 500. Now, since it's an index fund, it will almost certainly mimic the S&P 500. Now, is this everything you need to know about mutual funds? No. There's more, but considering that this is a beginner's guide, I think you'll have a good start with what was covered today. No matter what you do, it's always best to take your time, do your due diligence, and of course, open an investment account so that you can pick a mutual fund or funds that's right for you. By the way, do you own any mutual funds already? Or are you thinking about it? Let me know in the comments below because I'd love to hear from you and of course, respond to any questions you might have. In the meantime, thank you so much for watching and I'll see you in another video. Bye!